Guess what? This is why I love real estate. When you raise that rents, guess what doesn't go up? Your debt, landscaping bills, maintenance bills don't go up when your rent goes up. It's the same. So this is the thing. Your income goes up, but your expenses usually go down as you manage it more effectively. And so this is why they say debt is the best hedge against economic times and inflation, because when our rents inflate, guess what doesn't inflate? What we owe on the property. And so that's the power of finding a value add.
Hey, what's going on, cash flow hackers? It's Chris with Life 180, and I am here with my buddy Mike Fritz from Power Up Real Estate. And today we're going to be talking about the 4 keys to successful multifamily real estate investing. Say that 10 times fast, like Gary. So, guys, Mike is an expert at the multifamily space, and so I thought, in the interest of adding a lot of value to everybody, and listen, the way the world's going on right now, everybody's interested in real estate. And I think there's also a lot of pitfalls that people can fall into, a lot of traps, a lot of scams. Anytime the markets get hypey, a lot of stuff happens. So I'm always looking to bring people that I work with and that I trust onto the channel to be able to serve you with value. And so, Mike, thanks for being here.
Hey, man, it's so glad to be here. I'm so thankful you guys tuning in today, and thanks for having me on here, man. Yeah. I'm so excited about multifamily real estate right now because it's one of those things that it allows people to start investing in something that pays them month after month without having to put in a ton of time if they do it the right way. And I know a lot of people, most people start in real estate, and I don't know if this is true in the businesses you own, but most people have start in real estate as a side hustle. Almost everybody starts in real estate as a side hustle. Like it's on the side. Totally. They don't go in and do it full time. So when you're doing it on the side, you need to make sure you're doing it in a way that creates freedom rather than takes a lot of time, or else you won't be able to do it. You'll get discouraged and you'll walk and you won't start buying real estate.
100%. So let's just get right into dropping some bombs and information on these guys, and let's talk about, you say you have 4 keys to successful multifamily.
Yeah. So when you think about 4, I call it the Lego method. So the Lego method has 4 key pillars of getting into this game. The first one is looking for properties. And the key with looking for properties is actually multifaceted. It's where to look, like what cities, what markets, and it's also what types of properties to look for. For example, Atlanta, Georgia, great multifamily real estate market. But there's some places in Atlanta you do not want to own real estate. So that's why it's looking is a multifaceted piece. Atlanta, one of the best multifamily markets in the country. There's some cities, there's some
little
parts,
pockets
you don't want to invest in.
Sure.
So when you're looking at there, you want to go with there's 2 things you look for when you look for really powerful markets. Okay. The first one is you look for job growth. That is the most important thing. When we're investing in real estate that we're going to hold long term, meaning we're going to create cash flow month after month, we have to have jobs be there because that's what's going to grow the value of that real estate. Because as multifamily, we own units. Well, what occupies units? People. And what usually draws people? Jobs. And so we want to make sure that we're in markets where there's job growth. That's one. And the biggest second one, and please listen to this one. Do not invest where there are not landlord-friendly states. So if you invest in a tenant-friendly area, you're going to be on the back end of a very undesirable situation. A friend of mine actually owns a lot of doors in New York City, and it took him over the last year. It took him almost 2 years to evict a tenant not paying rent over the last COVID. Now, when you're paying, $500 a month, that's still a lot of money. Well, when you're in New York and you're paying $3,000 a month, do the math. That's a lot of money.
Brutal.
I mean, sometimes that can bankrupt you. Yeah, it can be $50,000 to $75,000 in rent. And so, a really important thing is to make sure that you're investing where they're landlord friendly. And I'll just rattle off some markets for you. Just rattle off some markets that I love. Atlanta, Georgia is great. Charlotte, North Carolina, great. Any North Carolina, South Carolina markets are going to be really powerful. Nashville, Tennessee is one of the hottest markets in the country. Actually, interesting fact, more people moved to Tennessee throughout COVID than any other state in the country. Really? Yeah, Tennessee attracted a lot of people. So Tennessee is a power market, especially Knoxville and Nashville, and then Memphis is now on the rise in that city. And then if you come down to Texas, the big 4 in Texas are always powerful: Dallas, Austin, San Antonio, Houston, power markets. And then if you move up into the Midwest, there's 2 Midwestern markets that I really love. There's actually 4, but there's 2 that I talk about a lot. Columbus and Lexington. Now, Columbus, Lexington, Indianapolis, Louisville are 4 Midwestern markets that I really like. Key in Indianapolis, another quick note for you, Indianapolis had the highest percentage of rent growth in 2021, any city in the country. And so,
really?
a lot of people don't know these little sleeper cities that it's like, oh, why would you go to Indianapolis? Because they're growing like crazy.
Yeah.
Again, why is Indianapolis growing? Jobs, because it's cheaper for a headquarters to have their business in Indianapolis than it is in New York City or Chicago or these big
Companies
metros.
are moving out of Silicon Valley,
They
out
are.
of California, out of New York,
They
out
are.
of Chicago, and
They
they're
are.
going to places where it's cheaper to operate.
That's exactly right.
Yep.
That's why when people talk about the recession that's coming, I actually think it's going to be regionalized. I think for the first time, we're not going to see as much national. We're going to see regionalized depressions and suppressions and regressions in markets, because I think some of these areas where people are flooding from are going to see the effects of that. So when you're looking for properties, you want to make sure you pick a proper area. Job growth, population growth, of course, which couples with job growth, and landlord-friendly states. And I just gave you some of my favorite markets. So
That's amazing.
that's a good tip to just make sure if you're going to go after markets, stick there and you won't lose.
And those are all landlord-friendly.
All of them are landlord-friendly.
Okay.
This is
Fantastic.
not. By the way, I'm gonna probably get kicked off Chris's channel for saying this, but this is not a political statement. But red states tend to be a little more lenient on the entrepreneurial side, meaning they're a little bit more landlord friendly.
Yeah,
It just is what it is, and that's
Yeah.
not anything against others. I'm not taking sides. I'm just saying, as I've looked at the market, the red states are the ones that tend to be growing more in the multifamily space.
I think that's
is what it
in
is.
general. I mean, because I have Mike Wolf on here for the single family stuff, and he says the same thing.
Yep.
I mean, the principles for real estate don't change. If you're renting your place out,
It doesn't.
and it's a revenue stream for you, and you're cash flowing it, you better have the rules in your favor as the owner of the asset. Right?
Exactly.
Like,
Yep.
So,
and a lot of times when people hear that, they think, oh, landlords are just trying to take advantage. I don't know any landlords that are trying to take advantage of tenants. I don't know. And I know a lot of landlords.
Sure.
I know a lot, and I don't know of any, because any good landlord knows that tenants are gold.
Mm-hmm.
They pay all of our bills and they make all of the wealth, or they create all the wealth.
Yep.
So you have to understand, my philosophy is we treat tenants like they are the only thing that matters, because they are.
if you find a good tenant, the tenant is the best asset.
They're
that
the
takes
number
your
one.
asset and makes it 10 times better.
Yeah. So when
Right.
when people say, "What do you think about multifamily?" It's great, but it is only great because of tenants. So
Yeah.
that's why most landlords understand that they treat their tenants like gold, and so it's not. We're not trying to take advantage of anybody. Our goal is to create safe, great places
Love it.
for people to live.
That's
So
amazing.
that's how you look for properties.
That's awesome. So
Yeah.
once you find the properties, let's
Yep.
say, okay, so we looked, we found them, we found a good area. Let's
Good
say
area.
we found a place in, let's just call it Atlanta.
Atlanta.
For fun.
All right, yep.
So we found a place in Atlanta. Now what?
So we find a place in Atlanta. Let's say we find a place in
In a good spot.
in a good spot in Atlanta.
Not
that
in
we
the
like.
dodgy section.
Exactly. So we find a place. Then what we're going to want to do is we're going to want to evaluate that property. So when you're talking with people who, however you got that property, if you got that from a wholesaler or if you got that from a commercial real estate broker, however you got that property sent to you, you're going to need the financials of that property. And so when we say evaluate the property, what we're talking about is looking at the income and the expenses of that property. Like, what is it costing to run that property, and how much
Sure.
does it make? And there's really a couple things I'm looking for when I'm looking at my numbers for a property. Of course, I'm looking at what does it cost to run. I'm looking at what income is coming in, but then I'm looking at what income could it make. So the best multifamily properties are what we call value add properties. And value add simply means we can either increase the income or decrease the expenses to create more revenue.
Okay.
So if you can do one of those two things, that's considered a value add property, and that's where the real money is. I'm telling you, that's where the money is. So we want to find a place that's renting out at 800 that could really go up to 900 or 950. And so we buy a 10-unit building, scale across that, and you've got quite a bit more revenue. And guess what? This is why I love real estate. When you raise that rents, guess what doesn't go up? Your debt, landscaping bills, maintenance bills don't go up when your rent goes up. It's the same. So this is the thing. Your income goes up, but your expenses usually go down as you manage it more effectively. And so this is why they say debt is the best hedge against economic times and inflation, because when our rents inflate, guess what doesn't inflate? What we owe on the property. And so that's the power of finding a value add.
People don't, like, total side note, but people miss that point when it comes to debt for real estate all the time.
Gosh.
If you get a 30-year mortgage on any kind of property, you want to finance for as long as you can for the best rate possible, because let's say you're making a $3,000 a month payment for a mortgage, and you're making that today. When you go to make your last payment 30 years from now, that you're still making the $3,000 payment, but the actual purchasing power of that money then is going to be the equivalent of like $1,300 in today's money.
100%.
So every single year you have a fixed mortgage payment, you're basically getting a discount. Even though you're still cutting that $3,000 check, you're still getting a discount. So that's really important to understand.
It is 100% important. And this is what I love about real estate, because when I first got into real estate, I got into buy houses. Little did I know the industry would turn me into a financial geek.
Yeah.
You know what I mean? Because it did. I totally am. It turned me into a financial geek of all these numbers, because when you lock in against a stronger dollar, and as the dollar weakens, guess what? You don't change. Right. But as inflation goes, guess what does change? Your income. Because rents inflate, but your debt doesn't. And that's the power of owning this. So when I'm looking at the evaluation of the property, looking at my expenses, my income, and I'm seeing my net income, right? So let me tell you one quick thing, just a quick tip. When a bank gives you money for real estate, they have this thing called a DSCR. It's a debt service coverage ratio. So what that means is once you take all of your income and take out all your expenses, you have this number left over. That's called NOI, net operating income. When you have that net operating income, that number needs to be 1.25 times the mortgage payment. So the bank is going to want to make sure that NOI is 1.25 times above the mortgage payment. So for every $1,000, they're going to want $1,250 of net operating income. Every $1,000 of debt, $1,250 of net operating income. So to make sure that you can make the payments and not get behind with your income. So when you're evaluating, I'm looking at that number. Hey, does the number make sense? Or will the bank even give me money on this? So that's how I evaluate.
So that's how you evaluate. And when you find so that's basically your success metric as you're evaluating. You're looking for those numbers, and when you do, you know you can approach a bank and get the number. Get the number that you need. Get
what I need to get. Yep, absolutely.
All right, so let's get into number 3 now.
Yeah, number 3. So after we found it, we've evaluated, now it's time to get the cash. So it's time to when we buy multifamily, we get cash from 2 people. Institutional money and private money. So we get cash from institutional money, that's banks, that's your local credit union, or sometimes we'll get what's called agency debt. Now, agency debt is Fannie Mae, Freddie Mac, government loans. Those always loan out at better interest rates, by the way, if you can get that. But there's some more stipulations behind getting that debt. So we're going to get institutional money, and we're going to come over and we're going to get private money. So when you buy a property, we need to usually have 25% down, a 25% down payment.
Sure, fair enough.
We need appraisal, inspection, closing costs, all of that money. Here's the power of multifamily real estate. In the last 18 months, we've bought 452 units, and we've never used $1 of our own money. No money has come out of my bank to buy these. I've never paid for an inspection, never paid for an appraisal, never paid for a closing cost. I bring private investors in that invest and pay that down payment money, and then I own 30% of the property, and sometimes it's 20% for a few years, and then it moves to 30. But either way, I own a portion of that equity, and I don't put any money in the deal. So you might be sitting there. So this is why I love talking about money, and you know this from talking so much about life insurances. People often, if you look at your own bank account, and then you decide what opportunities exist for you, you will always stay broke. You just can't do it that way. It just can't be done that way. And so when you get the money, I build relationships with investors, and I ask them for money. Now, here's a quick side note with multifamily. When I close on a deal, every time I close on a deal, I get a 2.5% fee for putting the whole deal together. So when I'm raising money for that down payment and all that, I raise an extra 2.5% from investors, and that goes to me. So for every $1 million, I take a $25,000 fee. So if our deals are $5,000, I'm going to make $125,000 on of a fee. $5 million. Did I say 500,000?
You said 5. I think you said 5,000.
If you find a multifamily for 5,000, email Chris and I. We will get that deal done today. No, $5 million. $5 million. We're going to get a $125,000 fee on that. And here's the cool thing: I don't put any money into it. I put a little bit of time into it to get this deal, and then I make a good check at the end. So if you can close on 2 of those a year, you can make a pretty good income. And then you still have your equity in the deal. So you got to get that money.
That's amazing. So guys, before we get into the next step, I want to just encourage everybody, if you haven't already, make sure you subscribe, hit the bell, get notified, and also down below in the description, I'm going to put a link to Mike's channel because he runs an amazing YouTube channel as well where he talks about all this stuff. If you want to learn more, get deeper into the multifamily investment space and just the money space as an entrepreneur, anything, he does a lot of great content on that. Go check him out over there. We're going to have a lot more on the channel now as well, but
that's awesome. Thanks, man. I appreciate that. I think that when you get into the YouTube space, there's so much great content out there, but there's a lot of content out there that's not tested. And that's what Chris and I talk about a lot of time. You want content I actually don't want experts that's what they do for a living.
Yeah.
I want experts that are doing it and decided to throw up a channel.
Yeah.
Sometimes the ugly channels that don't even look that great are the best ones because they're like, dude, I don't have time to do all this production. I'm out actually buying real estate. That's what you actually want.
That's awesome.
And so, but anyway, you want to get into the fourth tip?
Yeah, get into it.
So this is where all of the money is made. So we just talked about you have to get the deal, you have to evaluate it, you have to get the money. But after you have it, you really can't experience any of the benefit without the fourth one, which is operations. You have to operate it well, meaning you have to collect rent. You have to make sure the rents get raised effectively every year. You have to make sure the property is taken care of. You have to make sure all of these things are in place. Now, please, please, please don't do like I did when I first got into this business and do it yourself. I managed all of my own properties, and I hated real estate when I managed my own properties. In fact, I want you to, instead of becoming a real estate owner, I actually want you to become a business owner. And that's what I had to switch in my mindset is, hey, I own buildings, but really what I do is I effectively manage people. And so we have a property manager over every single property we have. Now, sometimes we'll have properties in the same city and one management company will do all of those, which that's actually really great when you have one management team that you trust that can do multiple deals. Because the more deals you do in a city, the better deal you get from your manager. So that's actually a fun thing that we do is the more business we give to a manager, we can bring that fee down and some more money into our pockets. And but then you have to operate. And the key to operation is finding a great property management company. I actually did shoot a video on my channel about how to pick a property management company because the greatest mistake in my business is picking the wrong property management company. It cost me thousands of dollars. It cost me thousands of dollars. Please don't do that. But again, the Lego method of look, operate, get money, or look, evaluate, get money, and operate, those 4 steps, if you want to get into the real estate game, especially multifamily, that's really how it's got to get done.
That's amazing, man. So how can people work with you? Like, I know you do a lot of mentoring. You have a lot of stuff going on.
Sure. So we have a couple different programs. We have our Multifamily Blueprint Academy. If you email me, email our team at support@poweruprealestate.com. That'll go to our front desk, and then they'll let me know that it came from here. Let us just put in the subject line Life 180, which is Chris's channel, so that we know that where you came from. Just shoot an email to us so we can connect you with our Multifamily Blueprint Academy. The other thing we have is a private money CEO program, which teaches you how to raise money. It's a whole program on raising capital because that's what a lot of people are struggling with right now. And so just shoot us an email. We'll reach out. And then we do have a more of a group one-on-one program, but it also will depend. We have to vet people pretty hard to make sure they're ready for that kind of intensity because that's an intense program.
Yeah, absolutely.
Because we're really making sure you get it done there. But either way, we would love to hear from you and hear what you're up to. And thanks again, dude, for what you're doing to bring financial help to people, dude.
Thanks,
it's so good.
I love it. Well, guys, hopefully you found value in that. If you're still watching, I know you did. Like I said before, if you haven't already, subscribe, hit the bell, that way you get notified. If you have any questions at all, comment in the comment section below. I'm obsessed with responding to comments. I always tell people, if you want to get a hold of me, leave a comment in my YouTube videos more than sending me a text because I'm more responsive to my YouTube comments.
It's so true.
So go ahead and do that. And until next video, have a blessed, inspirational day. We'll see you then. Take care.